This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Need help in finding investors for your startup, fund, or angel group? 10 Capital provides funding as a service helping you find accredited investors. Contact 10 Capital to gain access to investors for angel and venture capital funds, family office rounds, and syndication raises. To learn more, go to 10capital.group. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Josh Chodniewicz, founder and CEO of Fundify. Fundify is a tech-driven equity crowdfunding marketplace that enables anyone to invest in next-gen startups alongside industry experts. Josh, thank you for joining us.
It's great to be here, Hall.
Great. So what was your background before investing in early-stage companies?
Before that, I started and founded art.com and allposters.com. We bootstrapped the business with $35,000 and built an art poster print custom framing shop online.
Great. So what excites you right now?
Well, I am excited about the law changes that have come into effect that allow for non-accredited investors to get invested into a very lucrative asset class inside of the startup asset class and being able to invest small amounts of capital, that something that has just not been available before.
Great. Can you tell us more about that and how's that working?
Sure. I mean, the New Jobs Act essentially allows anyone and everybody to invest on a platform like Fundify as little as $10 into a startup investment. Fundify aggregates those investments together and then invests it into the startups. And for the startup, it's much like a Kickstarter campaign. You might be familiar with Kickstarter, Indiegogo, GoFundMe. They aggregate funds. Those platforms are actually what we would call rewards-based platforms. And so you don't really make an investment. You put some money into this company and maybe you'll end up with a bicycle at the end, right? That's really fun and interesting 6 months from now. Now, if you wanted to really invest a substantial amount of money, you wouldn't do that on Kickstarter because you don't need 1,000 bicycles. But the reality is you would like to get the financial returns of a great company. And so if you've got a really amazing, interesting technology that you know about, the way to really get involved is to, if you're from an investor perspective, is to get equity in return for that risk that you're taking for your capital. And so that's what an equity crowdfunding platform like ours does and enables the users to do that. And that's the thinking behind that.
Great. So you see a lot of investors and a lot of startups out there. What's your advice for people investing in startups? What do you tell them to do before they write that check?
That's a great question. The first thing I tell people is the startup asset class, I believe, is a wonderful asset class to be invested in. When you look at the data, it shows solid returns in this asset class, but you have to be fully aware of the fact that it's illiquid. So once you put the money in, it's not like investing in Apple stock where you could sell that tomorrow if you wanted to take that money back. You can't do that. Once you invest in startups, you have to wait the long haul and see what happens. In addition to that, however, I would also advise, the way I think about it is what I would share is you really need to be invested in a diverse portfolio of startups, no matter how much you like one or two. I mean, you can always take the big bets and try and see what happens, and it can be fantastic. But as you think about investing at a higher level, we recommend 40 to 50 investments at a minimum that you're getting into. So if you had, $50,000 to invest in startups, it'd be much more prudent to invest 1,000 into 50 companies than it would to invest 25,000 into 2. And that's a recommendation on the diversified side of the equation. And that's how we think about it, at least at a high level.
Great. And then on the other side of that table, what's your advice for startups? What do you tell them to do before they go out to raise funding?
Well, get ready to raise funding, right? Before you end up taking conversations, they've got to really get ready and put together the story that they're telling. Of course, they may already have a product, but building a company is different than actually building what you need to raise the capital that you need, right? You may not have thought about you do a lot of this, Hall, right? But helping companies put together their information in a way that investors want to see that and understand what could my potential be? What could my return be on such an investment? What does this look like? And answer all the questions that come along. In our case, we think you should be using technology to help you with the process of meeting with angel investors, meeting with non-accredited investors, and to maximize your abilities to raise capital, to maximize your efforts. And traditionally, it's been one-to-one meetings. You go to lunch, you meet with someone, and you hope and pray you answer their questions, and then next week you're trying to answer more questions in hopes that they make an investment. And I think what equity crowdfunding, the internet, Zoom, all these tools, plus so many others, they're allowing investors to now exploit the tools in a way that allow them to build information, decks, data rooms, and in a way that they can then share with multiple people at the same time. And that maximizes their time, essentially, eventually should turn into getting to your yes quicker or your no, if that's the case.
Great. Well, let's talk about the state of investing in startups. How do you see the industry evolving from here post-COVID?
I think people are looking for ways to invest money. I think venture firms, traditionally, I had a lunch literally yesterday where somebody was telling me, I've got this venture firm that just reached out to me and their minimum investment to be an LP was $10 million. And I thought, oh my goodness, $10 million just so you could be an investor in this venture fund that then invests on your behalf into startups. Now that's completely changed because you don't need to have those massive minimums. And I think that's going to continue to change in a way that more and more everyday people realize, I can be investing in this asset class too. I can hopefully find the next Uber early, right? The next DoorDash, because we all have our basics, the knowledge that we have in whatever field we're in. And sometimes we want to put we say, oh, I knew that was going to be successful. Well, nowadays you can invest in those companies if they're on equity crowdfunding platforms. So
what do you think is the biggest change you'll see in, say, the next 12 to 24 months?
Well, I think what we'll see is we'll still see a rapid growth in equity crowdfunding. So what's happening right now is we have triple-digit growths inside of equity crowdfunding. So the amount of capital that's going in is growing very, very fast. It's actually accelerating this year, which is phenomenal, which means it's still on a big growth path. And so what that means is it's an education that's happening. People are realizing they can do this, and then they're deploying their money into startups that they're saying, oh, okay, this looks amazing. On Fundify, for example, we have 12 campaigns running right now where you can get in and you can put as small as $10 into a campaign and you build a startup portfolio and you get to watch what happens over the months and years ahead. And you can come in at whatever amount. We have people coming in for $10 and investing across all of them. And then we have some people that are putting in thousands and saying, listen, I'd like to put in 10,000 per deal, because that's an interesting way to think about that. So I think that that's going to continue to evolve. People are going to become educated about these possibilities.
Great. Well, let's talk about your investment thesis. What exactly is it, and what's your criteria for choosing one deal over another?
Well, for us, we are a FINRA regulated entity. We comply with securities and exchange laws. So we are looking at all these opportunities that come through our top of the funnel. And we're making sure that the basics are done inside of those. But what we do in our thinking is that we're industry agnostic. So startups can come in from all kinds of industries to raise capital. And we'll never be an expert in every one of those industries. So what we do is we partner with, and we just look for people that are experts in whatever their relative fields are, and ask them to review the opportunity that we currently have. So we have a baby tech company that's on the platform. We find someone that was at Procter & Gamble, let's say, and that worked at Pampers. Now they've got some insights that other people may not have about that industry and some thoughts that they can share that will help you figure out whether that's an opportunity that you want to get involved in. So many times we're looking at opportunities that have already been vetted by larger investors that have written a check. And so that starts the vetting process right there. Someone else has already spent some time looking at it and making investments. And so We have a slew of criteria that we look at in order to determine which ones kind of make it to get to a point of the raising of the capital, and in hopes that, of course, that we find the good opportunities that investors can get into.
Great. Can you talk about one or two startups, maybe portfolios that fit that thesis?
Well, we have 4 live offerings right now. We've got a Baby Barista, for example, which is this tech startup that, they built essentially kind of a Keurig for baby formula. And so you can, press a button on your phone and 30 seconds later, you've got baby food in a bottle, warm to your temperature, and kind of makes sense. That's not that's not something that's easily accessible. We have we have a company called the Hydrogen Group that is built a technology that can be put onto trucks that makes diesel trucks 25% more efficient on their diesel, which is crazy when you start thinking about the costs of fuel and diesel. And so we're seeing innovative technologies. These are generally at the early stages. So there are significant risks with investing in these companies. But the idea, again, is if you're in a diversified portfolio where you've got a lot of these in there, some of them are going to do really well. And that's the hopes for that.
Great. Well, what do you see as the main challenge startups face today? What's the biggest thing you find them dealing with?
The biggest challenge for startups, I think, is their fundraising. I hear that over and over and over. I think that you probably hear that a lot, Hall, in your business. And the challenge that they end up in is that they spend an exorbitant amount of time fundraising, and they either don't have the contacts or they don't know how to build a deck and tell their story in a way that will eventually get them the result they want, which is the money in the bank. And then the challenge that incurs because of this is they spend, let's say, 6 months, 12 months raising capital, of which they could have been spending that amount of time actually building their company and their product. And so their product suffers because of that. And so it's this kind of vicious cycle of negative that could actually, imagine if you solve the problem of raising capital really quickly, then that startup is actually perhaps more likely to be successful because they have more time to work on their product.
Great. And then on the other side, what's the biggest challenge investors face in today's market?
I think investors, their challenge is that they're looking to deploy capital and you end up with decision paralysis, or they don't see, meaning they've got too many offerings to get into, or they don't see enough at all, right? So they never see great opportunities that are out there. Or they have, like we talked about it a little bit earlier, large minimum investments to get into a venture capital fund, right? And well, if you've got to come in with $10 million or $1 million or $250,000, that's just not going to be an option for so many people. So now you can get in for really small amounts and build that diversified portfolio. So the challenge becomes, how do you do that? How do you spend the time that you need in order to build that portfolio? That's what we aim to build, is a model and a platform where individuals can build out those portfolios relatively easy for themselves.
Well, great. So you see a lot of different applications and sectors out there. If you had to pick one or two that you think are really good immediate opportunities to pursue in today's market, what would you call out?
Well, that's a great question. We see, obviously health tech with COVID, there's a lot of new tech that's been funneled and funding that's happening inside of there. I think technology as a whole will still be very strong. Technology enables such a big growth opportunity, right? So because you've got computers doing jobs and so many more. I think computing powers is up 1 trillion% in the last 60 years, right? So you look at that, you say, wow, so much more can be done with computers. So that's technology for you. So anything that's involving technology that can magnify the results that would happen without it, it's got a lot of possibilities. We're obviously in the fintech space. We're seeing a lot of great technological evolutions coming in that space. And so we're big on fintech as well. Truth is, there's a lot of great industries. We see a lot of great industries with really interesting possibilities. I think it continues to happen where whenever you got smart people involved that are passionate and they get into something, there's great opportunities that they can find. And so that becomes this kind of challenge of finding the best ones.
Right. With the stock market at an all-time high, interest rates at zero, coming out of COVID with a whole new set of careabouts, it's something of a golden age for startups. There's just so many things to do and so much money to go put into place for it.
Yep, I agree.
So in the last few minutes that we have here, what else should we cover that we haven't?
I think you've covered most of it. The only thing that maybe I haven't talked too much about is that one of the things that we really like about what we're doing with Fundify is that with every opportunity that we bring, every startup opportunity, we try to find different people who understand that industry. So you can get insights from these people. And I think it's critical to find people that understand a particular industry perhaps better than you do, whatever that might be. Because if you're getting into a robotics company, wouldn't it be great to hear from somebody that works in robotics every day or has worked for a decade there? So those are the types of things we're trying to provide, is additional insights to the investor so that they can make proper educated decisions about their investment capital. And so, yeah, that's how we're thinking about that.
Great. Well, so how best for listeners to get back in touch with you?
For us, well, I think you have my contact information that you're going to be providing, but you can also just reach out at fundify.com and sign up, learn about what we're doing. We're regularly sending information out. You can email, you can reach out to us in so many different ways on the platform.
Great. We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you, Hall. It was a pleasure to be here. Thanks for having me. Enjoyed it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.